Good morning. It is Monday, January 13th, 2025. I am Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today. As a quick reminder, if you would like intra-week commentary, should any be published, it'll be on both LinkedIn, Herb Morgan, please follow me there, and X at Herb W. Morgan. Everything you're about to see and or hear has been created by me for you, whether you are an individual investor or a financial advisor, doesn't matter. All of what we say should not be treated as investment advice. No tax advice, no purchase or sale of any securities. Everyone is expected to make their own investment decisions. The views are mine alone, do not necessarily reflect the views of CFIA's parent or affiliates, or even other portfolio managers here at the firm. Well, I think we are now into the correction. The question is, how deep will the correction go? How far will it go? How long will it last? Especially knowing that this week is the beginning of earnings season. And of course, we know the economy is quite strong. So we're going to get into this week, why are stocks going down if the economic data is good? Let's start with what happened last week. Across the board red in the equity markets. Small caps really took it on the chin, down almost 3%. International markets did a little better, a little bit of a buffer there. So you think about it, it's tech, it's big cap, it's mid cap, it's small cap tech, small cap financials. That's interesting going into this week because the first week of earnings season is always when the financial stocks report their earnings. Interest rates clicking higher. Aggregate bond index down almost 1% on the week. 20-year Treasury bond index down 2% on the week. And look at this. This is interesting. I said this last week and the week before. I expect a really good year for our alternative investment holding, which is Merger Arb. Why? Lina Khan, the previous chief of approving mergers and acquisitions, has been very difficult for businesses to work with, not approving deals, delaying deals. Things just weren't happening. It is now widely expected that that will change. Obviously, a new head, a new decision maker in a new administration, and you're already beginning to see it. Merger Arb, which is a very boring absolute return kind of strategy, already up 1% for the year. Let's get into the economic data, which I said was across the board good. So, of course, I probably had the question 3 times on Friday. If the data is good, all of the economic data we're getting is excellent, actually, almost all, then why the heck did the stock market go down? Okay, S&P Global U.S. Services PMI. Remember, we divide the economy into 2 parts. Manufacturing is about 15% of the U.S. economy. Okay, great. Services is about 85% of the U.S. economy. And if you look at that reading, we haven't had a reading this high since early 2022. Came in at 56.8. That was below the estimate of 58.5, but it's still an excellent reading. It shows that the economy is quite strong. Now, a competitor to S&P Global is the Institute for Supply Management, or ISM. Their services reading for the exact same time period, December, rose from 52.1 to 54.1. That was above expectations. New orders growing above 50, suggesting that future months, near future months, will also be above 50, showing expansion. Business activity really shot higher, 58.2. You start getting in the high 50s, you're talking about inflationary territory. And we're going to get back to that inflation theme here in a moment. And employment still growing, but growing at a little bit slower pace. So there was mixed data, let's say, on employment last week. Factory orders for the month of November down 0.4% after a 0.5% gain in October. But it's a very volatile series, doesn't necessarily mean slowing economy. Back out transportation, second consecutive months of 0.2%. Why do we back out transportation? Big ticket items, airplanes, aircraft, tend to skew the data because they just come in a lumpy fashion. So Boeing gets a big order, that kind of thing. So we smooth it out by looking at the transportation piece of data. The nation's trade deficit grew again in October to $78.2 billion. Remember, the formula for GDP is consumption plus investment, which is CapEx, plus government spending, plus exports minus imports. So when you have a trade deficit, you are subtracting from GDP, and when imports go up, that increases your trade deficit, and they go up more than your exports, that would increase your trade deficit as well. But widely thought that there was a lot of buying ahead of potential tariffs that are likely to come about immediately with the new Trump administration takes office a week from today. So we would put that as a one-off, not necessarily a trend or something cyclical that's happening in the economy. Consumer credit, which is a great sign of the health of the consumer, fell $7.5 billion in November. The estimate was for a $10 billion increase. So not even close there, the consensus of economists, after gaining $17 billion in October. What happened? Revolving credit, that's your credit card debt. It dropped by $14 billion after gaining 15 the month before. There's a lot of explanations out there. Nobody knows for sure. It's a big drop. We haven't seen drops like this really since the COVID-related recession when people were losing their jobs. People are not losing their jobs now, but it was a big drop. So the most likely reason for this, and I'm not even 80% on giving you this, but the most likely reason for this is there's a conscious effort by consumers to pay down debt because rates are just still so darn high. Now, the Fed has been cutting interest rates since September, but they only cut the shortest of short-term interest rates. The market set interest rates on 5 and 10-year treasuries, corporate debt, and consumer debt, consumer lending, those market set interest rates are actually going higher because of the inflation. And the non-revolving credit, though, however, did go a little higher. That was because there was an increase in auto sales. So on the one hand, we have this strong economy. And I think the other likely way to analyze this data is to look at this and say, you know what, maybe we're bifurcating more and more between, the higher end of the economy, folks like my clients, right? The people with assets that are investable assets and balance sheets, and the folks that are working paycheck to paycheck. And it's getting harder and harder for the paycheck to paycheck folks mostly because of the inflation, cost of housing being a major component, food, shelter, clothing, all that right behind it. And so we are getting a greater gap in the economy. Hopefully we'll get policies coming up in the new administration that serve to close that gap and help the working folks in our country. Weekly claims for unemployment, which is probably, as you've heard me say 100 times, the best real-time indicator of what's happening in the economy, fell to 201. 201 is low. Estimate was for 215. Continuing claims remain very low as well, 1.86 million people on continuing claims for unemployment. We've been here, as you can see, all back since the post-COVID reopening, and we've been at this 200 level. Lowest in absolute terms, absolutely the lowest in relative terms in the history of the data series, which goes back to the 1960s. Staying on this theme of employment and jobs, which is the major number one driver of the U.S. economy, if people are working, we have consumers. And we now have more job openings than we did the previous month. Job openings rose from 7.8 million. We were expected to actually go down a little bit to 7.7, and they jumped to 8.1 million. So there's 8.1 million open and unfilled jobs in the economy. We are, you can see that trend coming from the end of the financial crisis, the economy growing, getting stronger. The initial drop when we shut the world down for COVID, the massive surge in openings when we reopened from COVID, and then the slow normalization. I would say we've normalized and we're back to this trend. You see that trend, which goes, it goes 15 years, right? That's a 15-year trend there, up and to the right, and I think that's where we are. It was also the first week of the month, so as you know, in the first week of every month, we get the two big national jobs reports. One from ADP, Automatic Data Processing, massive payroll and benefits company, and the other from the government's Bureau of Labor Statistics. We'll start with ADP. They say private payrolls grew 122,000. That was a little below expectations. And so we're all scratching our head a little bit saying, I thought things were a lot stronger than that. It was a little bit less than the gain in the prior month. Service sector added 112,000. Goods producing jobs added 10. No big deal. But we always get both reports in the same week. ADP usually comes Wednesday or Thursday, and then the Bureau of Labor Statistics, the non-farm payrolls report they call it, comes on the Friday. And it was a blowout, way above expectations. Expectations for December, 165,000, come in at 256. That was on top of a 212,000 gain in November. So, and the unemployment rate fell from 4.2 to 4.1. All of this was strong. The Keynesians are saying, hey, this is the problem for the inflation. The economy's too strong. We need to slow down the economy. I just don't agree with that. You can have solid economic growth without inflation. You just can. It's always been possible. If you manage the monetary base appropriately to accommodate the growth, you can do that. We, however, have turned and we've relied too much on the Fed, and the Fed's arms are tied. I'm not sure they have more tools to control this inflation. The inflation is being driven by deficit-financed fiscal spending. The data is just overwhelming in support of that view and that theory. So we're going to have this strong economy, massive growth. But if the government keeps spending outside of what the economy can bear, it drives up prices and creates inflation. 7% fiscal deficits, not in a time of recession, not in a time of war or national emergency of any kind, create this inflation. So the Fed is limited. So the new Congress and the new president need to act if they're going to contain the inflationary pressures. Finally, we got Michigan consumer sentiment for the week. It fell just a little bit from 74 to 73.2, a little bit below expectations. Current conditions, though, were higher. Expectations are what fell a little bit. So I opened up this week by saying, hey, good economic news, send stocks lower. What gives? We had great week. You just heard the reports, right? Weekly claims for unemployment, fantastic. Services, 85% of the U.S. economy, fantastic. New jobs creation, at least as measured by BLS. Maybe ADP catches up next month. We'll see. Fantastic. All of these suggest that the economy is absolutely not weakening, even though the Fed was worried that the jobs market was weakening and that the economy was weakening, and so they started cutting interest rates back in September. Now, maybe in their to their argument, say they were just getting ahead of it and the rates were abnormally high, and that's a little bit true, but inflation's not going down. They haven't got that drop off in inflation. Their target for core PCE inflation is 2%, and they are at 2.8%. If inflation remains higher, then interest rates demanded by investors will remain higher too. If inflation's at 2.8, bond investors aren't going to be happy with earning 2.5. They need to earn something above the rate of inflation. So interest rates, even though the Fed's cutting the short end, interest rates are going higher. We're getting near 4.8%, for example, on the 10-year U.S. Treasury. Well, if interest rates are higher and the 10-year U.S. Treasury is free of any risk because it's guaranteed by the full faith and credit and the military might and power, the legal institutions, the courts of the United States of America, then I'm going to demand, and all investors are going to demand, higher earnings yields, returns on stocks. Stocks carry risk, significant risk. There's no government guarantee. So if I can get 4.8% or 4.7 or 4.6 without any risk, then I need to get a higher return on stocks. Well, if earnings are at a certain level, to get a higher earnings yields, the price of stocks must start to come down. And that's what we've been talking about for the last 90 days. I kept saying it wasn't going to happen until the first of the year. People didn't want to do the sales until the first of the year, so they wouldn't have to pay the taxes in April of this year. Sales in January of this year, the taxes get paid in April of the following year. And we're seeing that correction begin to happen, even though the economy is strong and likely going to get stronger. The question is whether or not we can get the inflation under control. Right now, the markets is saying, I don't think we can. Therefore, we're sending interest rates higher, and the Fed is really getting, in a sense, neutered in their ability to contain inflation. This is a graph, two different axes, one's left, one's right, not all that important. The white line is the NASDAQ, and as you can see, the white line is the white line is the NASDAQ, there it is. The correction is 6.64%, 6.5% so far. Not that much, not a big deal. The yellow line is the S&P 500, and that is down 5% or 4.9% so far. They're both down a little bit this morning as I'm recording this. I have said all along, I'm looking at maybe 15, could be as much as 20, depends on what happens in the first weeks of the administration. And more than anything else, to go further from here, remember I always say, do not try to preempt a correction. You just heard Herb Morgan say, I think the market go down 15, even 20% from the high. Well, none of us invested on the all-time high, right? We've been investing for 20 years, 30 years, 10 years, 40 years. And so I haven't lost 6% or 8%. Yeah, from a one-day valuation, of course, but who cares? So we don't try to preempt corrections. We don't try to time the market. But what we do is we're prepared for these corrections, and we try to react. How have I prepared during this run-up? Well, you who are clients know we've reduced a little bit of equity exposure in the portfolios. We don't go to cash. That's silly, it's juvenile, and it's irresponsible. Instead, we've reduced our targets right in line with our benchmark weightings to equities. And I believe, because the economy is strong, because I think the upcoming policy is going to be pro-growth, pretty obvious actually, that if we get this 15% or 20% correction, notice I said if, my plan currently is to react, not preempt, but react to that correction by doing what? Most likely increasing the equity exposure in the portfolios. So we'll wait and see if it develops. But it might not. That's why we don't preempt it. Why might it not? Well, earnings season begins this week. We always start earnings season with financial stocks. Wednesday, we've got BlackRock, Bank of New York, Wells Fargo, JP, Goldman Sachs, and Citibank. All the big banks, the money centers, the bulge brackets, whatever you want to call them. Thursday, U.S. Bank, M&T, PNC, Bank of America, Morgan Stanley. And then we start with some other stuff too. We've got United Health, they've been in the news lately, and J.B. Hunt, the big trucking and transportation company. And then we move into all the industrials and the energy and the materials and the consumer discretionary and the consumer staples and big tech. And boy, being out of the market during earnings season for big tech the last couple of years would not have been wise. And so maybe this correction gets cut short. I just don't know. I don't want to trade it. I still think we're going to get that 15% though. I'm not trading out of the market. That would be a dumb bet. Okay, moving on. Economic data this week. We've got tomorrow, small business optimism, producer prices. That's an inflation reading. New York State manufacturing, consumer prices on Wednesday. As always, on Thursday, jobless claims. Then we've got retail sales, import and export prices, Philly Fed survey, inventories, housing sentiment's horrible. Interest rates, since the Fed started cutting, going up. I know everybody thought the Fed cutting rates were going to get lower mortgage rates, and that's going to save the residential real estate market and maybe the commercial market and the office building market. Not happening yet. Friday, housing starts, permits, industrial production, and capacity utilization. We're always available. You're driving in the car, say to your smart device, hey Siri, hey Alexa, whatever, please play Herb Morgan's podcast, or please play Slaying Bulls and Bears. Here at Slaying Bulls and Bears, I try to make the complex and complicated simple and sensical. It's available everywhere, but the best place is the YouTube. On the YouTube, you can see all these charts and graphs, as well as hear my voice. I encourage everybody to please subscribe, thumbs up, like, give me a comment, anything. It really, really helps as we try to expand the readership and listenership to as many folks as possible. Thanks. I will be back to you again in 1 week.